Introduction. Income statement shows information during a set period of time and a statement of financial position. A statement of assets, liabilities, and owner's equity as a specific date. Those two are the most commonly leads to financial decision. Sa dalawang to nakasalalay ang decision ng kinakaharap at kinabukasan ng isang kumpanya. Cash is a money in the form of currency, which includes all bills, coins, and currency notes. A demand deposit is a type of account from which funds may be withdrawn at any time without having to notify the institution. Cash flow statement tells you how much cash is entering and leaving your business. Along with balance sheets and income statements, it's one of the three most important financial statements for managing your small business, accounting, and making sure you have enough cash to keeping operating. A cash flow statement is a regular financial statement telling you how much cash you have on hand for a specific period. For example, depreciation is recorded as a monthly expense. However, you've already paid cash for the asset you're depreciating. You record it on a monthly basis in order to see how much it costs you to have the asset each month over the course of its useful life. But cash isn't literally leaving your bank account every month. The cash flow statement takes the monthly expense and reverses it, so you can see how much cash you have on hand in reality, not how much you've spent in theory.
Hello guys, I will discuss to you the income statement and financial position. So first, the income statement is a summary of a business revenues and expenses over a period of time. It involves IFRS, that's called International Financial Reporting Standards, procedures that the firm recognize the revenue at the time of sales, but sometimes the company receives the cash before or after the time of sales. Income statement contains several non-cash entries, and it may not represent an actual cash inflows and outflows in a period of time, the largest of which is the depreciation. Depreciation attempts to capture the non-cash expense incurred as fixed assets deteriorate from the time of purchase to the point when those assets must be placed. Income statement is a financial statement that show you the company income and expenditures, and can also show whether company is making profit or loss for a given period, and focuses on a four key item: the revenue, expenses, gains, and losses. And the statement of financial position, also known as the balance sheet, represents the assets, liabilities, and equity at a single point in time. IFRS counsels the firm to show the production and other expenses on the statement of financial position as the sales of those goods takes place. So, the production and other expenses associated with a particular product's sales only appear on the income statement, such as a cost of goods and depreciation. Financial position, a balance sheet, is a summary of financial balances of an individual or organization. For example, assets include cash, stock, property, plant, or equipment, anything the business owns. Liabilities are what the business owns to outside parties. Example, suppliers, bank, or business loans. Equity is the remaining proportion of the owner's financial interest in the business after deducting any liabilities from the total asset in the business. To reading the financial position or balance sheet. When reading your balance sheet, it represents what your business owns and control. The asset, what is owns the liabilities, and the investment that the owner has contributed, the equity at a particular point in time. The accounting equation is assets is equals to liabilities plus equity. And I discussed the cash flow statement, the bottom line, and its usefulness. The bottom line of a cash flow statement, the difference between cash sources and uses, equals the change in a cash on the firm's statement of financial position from the previous year's cash account balance. That is, the statement of a cash flow reconciles income statement items and non-cash statement of financial position items to show changes in cash and marketable securities account on the statement of financial position over the particular analysis. Happiness is a positive cash flow. Cash flow is the single most important element for survival, especially for small and newly developing companies. Without cash, the company will not survive. Even the medium and large companies must control cash flow. Happiness is a positive cash flow. What does mean? It's simply explained as a movements of cash through your business. It's also called the company's cash budget. Companies studied their cash flow to determine patterns of how they take in and pay out money from their business. These are some questions companies are frequently faced with pertaining to cash flow. First, is the company generating sufficient positive cash flow from its ongoing operation to remain viable? It means whether the company's cash exceed its payout to maintain feasibilities. The second, will the company be able to meet its financial obligation to creditors? Yes, the company will be able to repay the loan on time because it has a sufficient or reserve budget for the creditors, because the companies before they set it up studied the money carefully so that it knows how to balance and budget money. The third, what expansion activities took place and how were those financed? Business expansion is funded through loans, as it is a quick and frequent choice in a small and starting business. Fourth, will the company be able to pay its customary dividend? Dividends are those paid to stockholders out of the company profit. 5. Why did cash decrease even though a net income was reported? So, this could be because the source of income is not liquid or has not been converted to cash. And number 6, to what extent will the company have to borrow money in order to make needed investment? One question an entrepreneur has before setting up a company is how much the company needs as an investment. Here are some tips to learn to know the money needed to invest in a company. The first is estimate your one-time start-up costs. Make important listing that will be needed for the business in your building, for example, supplies essential to be used within the company. And the second is estimate your working capital. It is necessary to know carefully how much money will be invested in the business to maintain stability. It should make a list of what company fees, such as taxes, employee salaries, telephone charges, and building rent area. And third, figure out a 6 months cushion. It is necessary to plan and analyze the needs within 6 months in a business so that it can prepare expenses and a company has enough budget to keep it stable. Number 7, what happened to the proceeds received from the insurance of capital stock? One should recognize that companies can fail even though they report net income. The difference between net income and net cash provided by operating activities can be substantial. And I will discuss the net income and net cash. First, net income, also called net earnings, that is being calculated as sales minus cost of goods sold, selling, general and administrative expenses, operating expenses, depreciation, interest, taxes, and other expenses. Net income: it is possible for a company to have positive cash flow while reporting negative net income. And if net income is positive, the company is liquid. And if a company has positive cash flow, it means the company's liquid assets are increasing. And a company can post a net loss of a period but receive enough cash from borrowing or other cash inflows to offset the loss and create positive cash flow. And the next is the net cash. It's a figure that is reported on a company's financial statement. It is calculated by subtracting a company's total liabilities from its net cash. Is a figure that is reported on a company's financial statement. Is calculated by subtracting a company total liabilities from its total cash. And net cash may also refer to the amount of cash remaining after a transaction has been complete and all associated charges and deduction have been subtracted.
What is the purpose of cash flow statement? The purpose of cash flow statement is to provide a summary of cash receipt and cash payment information for a period of time, and to reconcile the difference between beginning and ending cash balances shown on the balance sheet. The statement of cash flows clarifies how cash was generated and how cash was used for a period of time. It also identified the major cash flows occurring during the same period of time as the company income statement and between the related balance sheet. Cash flow statement identifies cash flows as being generated from three sources. First is operating activities. Operating activities include the cash effect of all transactions that create revenues and expenses and thus enter into the determination of net income. The second one is investing activities. Investing activities also include all those activities involved in long-term uses or sources of cash. Investing activities also include obtaining cash from issuing debt and repaying the amount of borrowed, and obtaining cash from stockholders and paying them into dividends.
Hello everyone, I'm Teresa Nicole Villanueva. Today I'm going to present the three classification of flow activities. The three categories of cash flows are operating activities, investing activities, and financing activities. Operating activities include cash activities related to net income. Investing activities include cash activities related to non-current assets. Operating cash flow. Operating activities include a company's day-to-day activities, for example, purchasing raw material or making sales. Investing cash flow. Investing activities include purchase and sale of long-term assets and other investments. Cash outflows are generated from investments in long-term assets and other investments include property, plant, and equipment. Intangible assets, both long-term and short-term investments in equity and debt issued by other organizations, etc. Financing cash flow comes from conducting financing activities for the business. In other words, financing cash flow includes obtaining or repaying capital, be it equity or long-term debt. Cash inflows in this category include cash receipts from issuing stock or bonds and from borrowing through long-term loans. Cash outflows include cash payments to repurchase stock and to repay bonds and other borrowings. That's all. Thank you.
So here in the financial liquidity and the financial flexibility. So in the financial liquidity, it refers to the measures to cash of assets and liabilities by using the current cash debt coverage ratio. So this current cash debt coverage ratio is a liquidity ratio that measures the relationship between the net cash provided by operating activities and the average current liabilities of the company. So what are current liabilities? For the additional information, the current liabilities are an obligation that must be repaid within the current period or the next year. Or we should say these are the amounts to be paid within 1 year, such as the salaries, interest, accounts payable, and other debts that can be found on the balance sheet. And the average current liabilities refer to the average value of a company's short-term liabilities from the beginning balance sheet period to its ending period. So the formula of the average current liabilities is the total current liabilities at the beginning of the period plus the total current liabilities at the end of the period. It indicates whether the company can pay off its current liabilities from its operation in a given year. So the formula for this ratio is given below. The net cash provided by operating activities over the average current liabilities is equals to the current cash over the debt coverage ratio. So next is the financial flexibility. It says here that the cash debt coverage ratio provides information on the financial flexibility. So here in the cash debt coverage ratio, shows how much of the company's total liabilities can be covered or paid with net cash from operating activities. So, in the financial flexibility indicates a company's ability to repay its liabilities from the net cash provided by operating activities without having to liquidate the assets employed in its operations. So here in the financial flexibility says that the company has the ability to repay their debts, no, in a period of time. So the formulas are given below. So the net cash provided by operating activities over the average current liabilities is equals to the cash debt over the coverage ratio. So the higher the ratio it is, the less difficulties will be encountered by the company in meeting its obligation as they come due. So in other words, the difficulties on meeting the company's obligations will be lessened, and it can be easier to them to pay debts and survive if the external sources of funds will be limited or too expensive.
Net cash is calculated by subtracting a company's total liabilities from its total cash. Ang net cash ay ang nagdedetermine kung mababayaran ba ng company yung mga liab or obligation. Net effect of those loss on cash equivalents during the period in a manner that reconciles the beginning and ending cash and cash equivalent. Non-cash investing and financing activities affecting financial position shall be excluded from a cash flow statements. Such transaction shall be disclosed elsewhere in the financial statement.
Statement of cash flows reports only those operating, investing, and financing activities that affect cash or cash equivalents. However, some non-cash investing and financing activities may be much important for the users of financial statement because they may have a significant impact on the current and future performance in the terms of revenues, profits, and the ability of the entity to generate positive cash flows. Some example of non-cash investing and financing activities that may become significant for the users of financial statements. First is issuance of stock to retire a debt. The second one is purchase of an asset by issuing stock, bonds, or a note payable. Third one is exchange of non-cash asset. The fourth is conversion of debt to common stock. The fifth one is the conversion of preferred stock to common stock. And the last one is payment for services availed by issuing stock in lieu of cash.
What are non-cash items? A non-cash item has two different meanings. In banking, the term is used to describe a negotiable instrument, such as a check or bank drafts, that is deposited but cannot be credited until it clears the issuer's account. Alternatively, in accounting, a non-cash item refers to an expense listed on a income statement, such as capital depreciation, investment gains or losses that does not involve a cash payment. Example of non-cash items include deferred income tax, write-downs in the value of acquired companies, employee stock-based compensation, as well as depreciation and amortization. What is a non-cash item? A non-cash item is an entry on an income statement or cash flow statement correlating to expenses that are essentially just accounting entries rather than actual movements of cash. Example: depreciation and amortization are the two most common examples of non-cash items. They are a standard feature of income statements whose purpose is to account for all of a company's expenses in given period. Though the company's asset to lose value over time, hence the need to record depreciation. The company does not actually write a check to depreciation. It is just an accounting entry to reflect the reduction in the value of the company's asset. It's crucial to remember to separate non-cash items from cash items in financial analysis. The presence of non-cash items are precisely why cash flow is not the same as net income, which includes transactions that did not involve actual transfers of money. Knowing when to add back the deduction for non-cash items helps the analyst understand how much cash a company actually generated or didn't generate. The statement of cash flows help with this.
So guys, now I will discuss to you the methods on how to prepare a cash flow statement. But before I discuss the two methods, we have here an example of a cash flow statement which dictates all the activities that are being reported in December 31 by the Sunstar Corporation. So here it discusses the three main activities in a cash flow statement, which is the operating activities, the investing activities, and lastly, the financing activities. In calculating cash flows from operating activities, we have the first method, which is the direct method of a cash flow. So, in the direct method, it dictates here that in reporting the cash flows from operating activities, enterprises are encouraged to report major classes of gross cash receipts and gross cash payments and the net cash flow from operating activities. The operating cash receipts and disbursement or cash payments are reported separately in the operating activities section. So, the total of operating cash disbursement or cash payments are being deducted from the total of operating cash receipts to arrive at net cash flows from operating activities. The net cash provided by operating activities, defined as the total of all operating cash receipts of the period, is greater than the total of all operating cash disbursement, while in the net cash used by operating activities, defined as the total of operating cash receipts, on the other hand, is less than to the total of operating cash disbursement. So we have here the formula on cash flows from operating activities. The cash received from customers and the interest and dividends received are the inflows of the cash flows from operating activities, while the cash paid to suppliers and employees, interest paid, and income taxes paid are the outflows on the cash flow from operating activities. To calculate cash receipts and payments in this format, we use some relevant data from the income statement, comparative balance sheet, and other additional information. So we have here another formula on how to prepare to calculate or to compute the cash flow from operating activities, which dictates here the income statement accounts, adjustments, cash flow from operating activities, and net operating cash flows. And then, in the direct method of a cash flow, it says here that enterprises that choose not to provide the major classes of operating cash receipts and payments by the direct method shall determine and report the same amount of net cash flow from operating activities indirectly by adjusting net income to reconcile it to the net cash flow from operating activities. So we have here the formula on how to prepare, to calculate, or to compute the cash flows from operating activities using indirect method. And here some examples